Welcome everyone to this session where we will dive into one of the most crucial components of successful trading, risk management. My name is Ali Mortazavi. I'm the head of education at Errante. I'm so thrilled to be with you today in this webinar where we're going to talk about the blueprints of implementing risk management rules on Errante's TradingView platform. In trading, risk management is not just a safeguard. We all know it's the foundation upon which all effective trading strategies are built. It involves a set of techniques that help protect your capital, control losses, and ensure that your trading decisions are disciplined rather than impulsive. So risk management is what let's say, differentiates a calculated trader from a gambler. So here you need to pick a side. You want to be a professional trader or act like a professional trader, or you just see trading as a gambling. Today we will define risk management as it applies to forex and safety trading, highlighting its role in managing volatility and uncertainty into markets. Because effective risk management ensures that traders have a safety net, allowing them to weather market fluctuations and capitalize on profitable opportunities while keeping their losses in check. So stay with me in this very exciting webinar. This webinar is brought to you by Errante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. And please, before we proceed further, note that all information provided in this webinar are solely for educational purposes. And please don't take them as any financial advice or let's say trading signal and something like that. Okay. And please let me know if the quality of the voice and the screen is okay from your side. So in that case, we will be able to continue comfortably. Thank you. Very well. Thank you so much for your feedback. Okay, let's start from here that imagine trading without guardrails. This is essentially what trading without proper risk management feels like. It's essential to establish these boundaries to ensure you stay on track toward the long-term profitability. So think of risk management as the foundation for all your trades, and that's why we're going to take it from to take it on around the trading platform from here. Yes, I hope you can see my TradingView platform right now. I'm checking it, and okay, it seems okay for everyone. Good. Thank you so much for your feedback. Thanks. Okay, practical risk management for forex trader can be broken down into several key components that work together to protect your capital and maximize opportunities. We already had some webinars on risk management techniques, but here we are going to make it more in a more practical way. And these components form actually the pillars of a robust trading strategy and help ensure long-term success. Let's start with one of the most important one, which is position sizing. Determining the correct position size, which is really crucial to every trade. It ensures that no single trade is the potential to significantly harm your trading capital. So proper position sizing aligns risk with the trader's accounts balance and risk tolerance, thereby preventing outsized losses. Calculating position size based on accounts balance, risk per trade, and market volatility is essential for consistent performance. And you know the formula, I guess. First, we need to set a percentage, a risk per trade, which is a percentage of our whole balance. And when you connect your TradingView account to Errante, you will be able to see this trade tab here. And then if you click here, you will have this, let's say, order window here. And by the way, if I pull it a bit higher, you can see the order, the history, the account summary, which is very important. It shows your balance, equity, and the profits or losses from your open positions. Right now, we don't have any open position. And then here, just below this order window, you can see your leverage, lot size, p value, and etc. All the details about your let's say position you're going to take here. Okay, so what we mean with position sizing is that first you need to set a percentage of your balance, or it's better to be on your equity, because if you are going to have multiple positions, to set an amount as the maximum risk you are going to take. This is the first step. And then you need a stop loss order. And setting a stop loss order, which is the second component of risk management toolkit, setting a stop loss orders helps limit potential losses on each trade. So stop losses should be placed based on the strategic levels, such as recent support or resistance levels. For example, I can show you here on the Euro USD chart. If you are not very optimistic about the euro rise, you can set this level as a 1.0914 as let's say as, the resistance level, and also you can point this supports level here, and also you can just note this very long gap here as a zone of interest, maybe for any further correction toward this level. So these are our support and resistance levels, and this is the first step to determine a very good position for a stop loss order. And then by doing so, traders can safeguard their capital without getting unnecessarily stopped out by market fluctuations. So you are going to down the risk. Additionally, using a stop loss order is necessary for effective position sizing, because when you're going through the formula, you need the distance between the let's say your entry point and your stop loss. So in that case, you will be able to calculate the pip at risk you have, and then you are going to calculate the size of your position based on the pips you have at risk. So position sizing depends on knowing the exact amount of risk you are willing to take on a trade, which is determined by the placement of the stop loss. For example, if you are willing to risk 1% of your $10,000 trading account, and your stop loss is set, let's say, 50 pips away, you can calculate the appropriate position size to ensure that the risk remains at $100. This way, stop loss orders help control the amount of capital exposed to risk and prevent excessive losses. For example, here I showed you that I have a balance and equity 6,864. Let's say it's about 7,000. So if for example, let's go to 1 minute chart to make it more practical right now here. Okay, let's say I see the break out above this last top here. This is a market range, but I'm going to long the Euro USD, let's say. And to do that, first I need my calculator here to see how much I'm willing to risk here. Let's say I have a 7,000 and I'm going to risk only 1% of my account, so this is a 0.01. So it means that $70 is the only amount I'm going to lose. So if, for example, I went for a long trade here, assume this is it's going to be my entry, and then here will be my stop loss. Oh, excuse me. Okay, it's going to be my entry, very easy, and it's going to be my stop loss. Okay, see here, and then I need to calculate the pip at risk, which is from this entry level to this stop loss. And again, I can easily do it by my calculator. Just need to subtract the stop loss from the entry, 9072 minus 1.9022. So it's only 5 pips. And then I'm going to risk only $70. Okay, so what if I just divide the 70 by 5 pips, and going to be $140,000, means a 1.4 let's say lot size. Okay, so here, which means if I enter this information here, it's going to be a risk of 1.22% of my balance. If I choose a stop loss, let's say 1%, so it's going to be about this level, 90, 22. It's changing because the price is changing right now. Okay, so here I can have this stop loss, and let's say I can go to buy it. Why it's higher than what I calculated? Because we are going to open a buy position based on the ask price, not the bid price. And what you are seeing on the chart is a bid price. So if I want to make everything crystal clear, I need to let's say also change my setting here, you see, and just turn on the line for bid and ask prices, and then I will be able to see them. And if you want also, you can go for the symbol. I can just turn them off, and instead I can turn on the value for them. Then I have this ask line and the ask price value, and the bid line and bid price value here. So in that case, I will be able to let's say have a more clear picture from the market. And then let's say I'm going to buy somewhere here. Yeah, market is changing, but doesn't matter. Let's stick to our plan. So right now you see I opened the position here and I calculated my risk. So if the price comes down to my stop loss, I will lose only $49. That's it. And I'm ahead of my, let's say, a risk per trade amount here in this trade. So I'm so comfortable with this trade, doesn't matter. So this is that's why we really need a stop loss order for our trading. This way, a stop loss order helps control the amount of capital exposed to risk and prevents excessive losses. And then we have the risk to reward ratio. This is another component of any risk management toolkit. Analyzing the risk to reward ratio before entering a trade helps determine whether a trade is worth taking. A good risk to reward ratio helps ensure that potential profits outweigh the risk. Consistently applying a favorable risk to reward ratio is a fundamental principle for long-term profitability. It allows us to focus on high quality trades. Okay, for example, here, when I have this entry somewhere here, I don't need this line anymore, so I can just remove it from here. And the risk to reward ratio is very important aspect, and we are going to talk about that because there are many details involved, so we need to explain it. And if you really want to get into more nuances about the reward to risk ratio, I would like to refer you to our webinar on risk management that we had. You can find it on our website, Errante.com webinars. So the next part is diversification. Avoiding overexposure by diversifying trades across different instruments or currency pairs reduces the risk associated with any single trade or market event. And this approach, and right now you see the market move down and it hits my stop loss here, but doesn't matter because it's less than 1% of my balance. So if I lost this trade, but I didn't fill up my whole account. So this is a part of trading learning. And this approach, I mean diversification, back to our discussion, minimizes the impact of unexpected market movements and smoothens overall trading performance. And using all of these tools allow you to maintain emotional discipline, which is vital in executing risk management effectively. So emotional control is another component. Traders should avoid making impulsive decisions based on market noise or fear and instead adhere to their predetermined risk management strategy. Emotional control is about detaching from the outcome of individual trades and focusing on the bigger picture, which is, let's say, being successful trader over time. So adhering to the system and not being swayed by short-term results. You have the right to be wrong. Actually, it's finally okay, but you have to be careful about your capital, and that's why we are using all of these risk management rules. And then utilizing trading tools. It's very important because, for example, TradingView combined with Errante's tools offer features that assist traders in setting stop losses, managing position sizes, and conducting in-depth risk analysis. And it's very important that you have a good understanding and good skill in using a trading platform that you are, let's say, trading on. It's very important. You have to be aware of all the features it has, and you have to be able of the abilities and capabilities that it can offer you. By using these tools, traders can effectively integrate risk management into their workflows, ultimately fostering more disciplined trading behavior. Leveraging such tools makes the process more systematic, reducing human error and ensuring that all aspects of risk management are thoroughly implemented. And well, I would say you will see that Errante's TradingView has features that let's say can help you to manage your risk in better way, to make it more systematic, and it will enable you to control your emotion in better way. So today we will focus on 3 key risk management techniques. First, setting appropriate stop loss orders, analyzing risk to reward ratios, and leveraging multiple time frames to minimize risk and maximize opportunity based on the features that TradingView offers. Let's begin this journey toward trading more strategically and effectively. Remember, effective risk management doesn't just keep you safe, it also gives you the confidence to trade with greater clarity and discipline. Okay, uh, if you have any question, you just write it down through the chat box. I would be more than happy to answer. If I know actually answer, that's cool. Okay, so if you don't have any question for what we discussed, and if you are totally let's say familiar with position size and all of this stuff, so let's move to the next section, which is setting and adjusting stop loss orders in TradingView. I would like to mention some tips that can be really helpful for all traders. And even you are, let's say, a seasoned trader, it's gonna be like a recap for you, because I know getting involved in more professional stuff or more complicated stuff and trading systems can sometimes be overwhelming for everyone. So that's I hope this session can be like a recap for you and like a refresher for this trader. And if you are a new trader, don't be shy to ask any question if you have. So let's start with understanding stop loss orders. We know stop loss orders are one of the most fundamental tools in a trader's risk management arsenal. Essentially, a stop loss order is an instruction to automatically close a trade once the price reaches a specific level, preventing further losses. And it's worth mentioning that all the, as you saw, the let's say buy positions usually buy positions get open at let's say ask price and get closed by bid prices. It means all the stop losses for buy position will be activated by hitting the bid price. Okay, and vice versa. We have for the sell positions that they are getting open with at the bid price, and then all the stop losses and take profit levels or orders will actually get activated if the ask price hits them. So that's why we, for example, the bid price hit our stop loss here, and then we got out of the market. Essentially, it's about deciding ahead of time the maximum acceptable loss you are willing to take on a trade. And this is crucial for protecting your capital, especially during volatile market conditions where prices can change rapidly. Static stop losses, let's say, remains fixed at a chosen price level, whereas trailing stop losses, if you're familiar with MetaTrader 4 and 5, there are trailing stop loss feature available that moves with the price. This allows traders to lock in profits when the market moves favorable while still protecting against downside risk. Static stop losses are ideal for trades where market conditions are stable, while trailing stop losses are more effective when price trends are moving strongly in your favor. It means if you are trading on a very short-term time frames, it's better to use another techniques other than trailing stop losses, because in very short-term time frames, usually the price movement is not that big, so it's gonna put you at risk, because you face some excuse me, market volatilities in a very short time time frame. So to prevent getting out of the market, it's better not to go with trailing stop losses. And there are other ways that that we can introduce, like the risk-free or changing your stop loss to your entry when you are in a good profit. That makes your trade break even. So uh, Uh, and you should be aware that while TradingView offers robust tools for setting static stop loss orders, it does not natively support trailing stop loss orders. Maybe something like a downside to this platform. However, trailing stop losses automatically adjust as the market price moves favorably, and they are very good for long-term or longer, let's say, time frames. Okay. And it helps trader lock in profits while still protecting against downside risk. The thing here is that, for instance, a trading a stop loss strategy by a user, you can use the scripts or indicators developed by the community on TradingView through this window here in the indicators tab. If you click here, this window will pop up, and then you can just search something like trailing stop loss. For example, you see there are many trailing stop losses, a script that if you, for example, try to activate them, you can use them from here. There are many of them. Yeah, trading sharp ratio, stop loss of long and short, and something like that. And however, it's better to check them and let's say first on let's say demo account, and then you can implement them on or apply them on your live account. So it needs uh, it needs you to be very careful with all of these scripts on the community, because most of them may work in very properly, but however, it's not the official script or something like that. So you really need to check it yourself on demo account first. Now let's move into TradingView to see how we can set these orders in practice. First, identify a recent trade setup. This is the first step we need to take. Let's move to another instruments like, let's say, GBP USD. This is a British pound versus US dollar in a 1 minute chart. Or let's go in a higher time frame, maybe 15 minutes. Okay, first you need a trade setup. Okay, you need to look at the market and understand what's going on here. On a longer time frame, you see we are in a very obvious downward movement with the lower tops and lower bottoms here. And after this correction, even after this correction, we have got to this level right now, thus just between the moving averages. Okay, let's take a look at this USD CHF, which is a more we can say a clear setup can provide. Okay, look at this supports level here, and we are witnessing emerging of this hammer candle I see here. So if the next candle, the next forever candle confirm this return of bulls in the market, then we can be confident of the completion of a pullback to this support level, and then that would be a buy opportunity for us somehow. You see, the market has tried before, once here, and also here, and this is the fourth attempt to break this support level down, but it wasn't successful so far. So we need first to wait to see if this session going to be closed above the support level. In that case, we will see the formation of a hammer candlestick pattern, and then the next candle above the high of the hammer can be a buy opportunity for us. Let's say this is a very simple trading strategy, and then we are going to take a look at momentum oscillators. We see none of them are somehow none of them confirm this, let's say, bullish setup here. Both of them are in selling zone, but doesn't matter. As soon as we get to the next session and we see a price moving higher above the high of this hammer candlestick, we might see that the RSI and MACD changing the direction to upside. Okay, but right now, so it's not a very solid trading setup. However, if we want to for example, trade the hammer candlestick, the best place to put our stop loss is the low of the hammer. So here we can have this level as the stop loss. So suppose we are going to trade this buy setup here, and here can be, let's say, in the next session, if we see a good confirmation that this ask price here can be our entering price, and then we decide to place our stop loss at this level, the low of the hammer candlestick, ensuring our risk remains controlled. So I trade on TradingView, we can use the built-in order panel to enter this stop loss level directly when placing our trade. This straightforward process helps ensure that traders maintain discipline and follow their risk management strategy. As you see here, we can just set our stop loss level here, and then we will be able, but remove it for at the beginning. Okay, Jen, it's better to set your stop loss here, and then you will be able to calculate your position size. The next thing we can do is, for example, here we can go for, let's say, a stop order. Why not? It can be a stop order, and this is our price here. And then we can calculate again the risk and the pipette risk. And if that's our entry, which gonna be 0.86383, or excuse me, this green price is the one we are going to set our stop buy stop order there. And here is our stop loss, so 0.86196, and here it is, 21 pips. It's the distance from our entry to our stop loss, which means this is a pip that we have at risk. So here, as you saw, if we are going to risk only $70, that's a 1% of our trading account. So there divided by 21 pips, it's going to be a 33,000. This is the size of our position. So it's going to be 0.33. That's it. Yeah. USD 76. Why is it? Because I assumed that we are going to risk a 1%, which is of our balance, which is less than 7,000, but we rounded it to 7,000. It doesn't matter. Okay, so here it is. And what should be our price? Our price should be 86406. This is it. And here we can just open a buy position. You see, we get this notification here. A stop order placed on USD CHF at this price and a stop loss placed on this price. That's it. Very simple. So, but we know market conditions change, and so should your risk management tactics. With TradingView, you can modify stop loss levels as the trade progresses. So in that case, you need to do all of those trailing manually. However, for example, here you can, if you get your trade open, so you will be able to modify it based on the market condition. If it's going higher, so you can bring your stop loss to your open position, and that will be a case for you, or you can reduce the risk, or you can increase the risk as well by changing your stop loss based on the pips, based on the price, or based on the US dollar, which is your account currency. Okay, so you can manually adjust the stop loss by dragging it to a new level to secure part of your gains while still allowing the trade some room to breathe. And next one is the most important part here is another effective way, let's say, to adjust the stop loss levels is by using the average true range indicator. ATR measures market volatility, giving traders a dynamic method to set stop loss orders that adjust to current market conditions. For instance, if the ATR value here, let's go for the ATR, we can find this in indicator window. What you see here is that the ATR currently is 23 pips. Okay, it means the market can be volatile than your stop loss or than your pip at risk. It means if the market goes very volatile, the price changes can be more than 21 pips, which is your stop loss distance from your entry, and that means your stop loss is very tricky level, is at a very tricky level right now. Okay, here is the tip. For instance, if the ATR value for this pair is only 23 pips, you may set your stop loss 1.5 times the ATR, or 75 pips. Or if you put it there, you can just reduce the size of your position somehow compared to the ATR by maybe 10%, 20%. It means 30, you can reduce it. That will be a more conservative approach to that. So this approach ensures that your stop loss is far enough from a regular market noise. And here you might think that 23 and 21 pips are okay, are manageable, but if you are trading on a very low time frames, like at 15 minutes or 1 minute, so it's very important to have your ATR on the chart. So in that case, you will be able to adjust your stop loss based on the level of ATR. Because adjusting this way can reduce the likelihood of premature stop outs. You see, it's a very common between traders that they usually say, put my stop loss below the, let's say, market top or market bottom, and then the market hits my stop loss, and then went through my analysis just in the direction that I expected. In that case, you got out in loss. However, you would see that your analysis was correct. So ATR-based stop loss setting allow for a more adaptive and responsive risk management approach, particularly in volatile market. That's why many professional traders usually at least compare the stop loss distance from their entry with the ATR, which is really useful. So TradingView also allows you to set alerts for when prices approach your stop loss levels, helping you stay aware of the risk dynamics of your active trades. And here you can set alarm. You can use a very alarm icon here, and then you can easily set your alarm at any price you want. And even if you have a trading, let's say if you have your strategy on the side, on the chart, you can just decide which level you gonna watch, and crossing between the price or any of these indicators or oscillators value you have on the chart gonna you want to be alerted about, or there is any specific order that you really need to get alert about that. So it's very simple. You can just choose, for example, the price, and here you can set a value, or you can set a level of this indicator. For example, you can set the alerts when the price crosses above the WMA. But here, as we are going to, for example, set a value, this value can be our let's say our entry price, so say 86397, something like that, or a 406. Yeah, so only once. So if I go to create it, I will have this here activated, and then if the price gets to this level and hits it, I will get notified. So this is another way. So if you are trading, or if you have a watch list, you are waiting for the best, let's say, trading setup across multiple charts or instruments, so you can set alarm on a beforehand, and then you will be notified if there was any, if one of your trading setup happens. Okay, so the next one that I'm going to give you some tips is risk to reward analysis. The risk to reward ratio also is a critical metric that traders use to evaluate the potential of trade relative to the risk taken. It's a very controversial, let's say, debate concept between traders, because a risk to reward ratio of, for example, 1 to 2 means that for every $1 risk, the potential profit is $2. So trades with favorable risk to reward ratios are crucial for long-term profitability. But if you get a very high reward to risk ratio, it's gonna decrease the chance of your win rates. So because the price may not go that far. Okay, so it's really important to have a balance between the win rate and the reward to risk ratio. A consistent application of favorable ratios allows traders to maintain an edge in the market, even if their win rate is not exceedingly high. That's the case. But if you have a very normal trading strategy with a high reward to risk ratio, that would suit you. But if you are concerned about the win rate of your trading strategy, in that case you might need to adjust, or somehow to change your reward to risk ratio to have more successful trader and in order to increase your win rate. So while the ideal risk to reward ratio can vary based on the trader's strategy and risk tolerance, a ratio 1 to 2 or higher is often considered optimal. especially for maybe intraday time frame. So this ratio allows traders to be profitable even if they win only half of their trades. So in that case, any reward to risk ratio above 1 to 1, which means with a 50-50 strategy, you're going to be successful at the end of the day. So for more conservative traders, a 1 to 3 or even 1 to 4 ratio can help ensure that only high quality setups are taken. But this is one thing, this is a common sense about the reward to risk ratio. However, if you are not that good in predicting the market movements, or it's going to be a very choppy day for market based on the calendar, based on the events, and based on the systematic risk and unsystematic risk, so it's better to choose a lower reward to risk ratio to keep the rate of our wins, our win rates, stable. So however, there's a balance based on the expectancy formula that we discussed at one of our risk management webinars. Again, I would like to address you to our webinar on the website Errante.com. So that case, you can find all we illustrated the expectancy formula, how to make a balance between your trading strategy and based on the reward to risk ratio, and also uh, let's say the win rates. So in that case, you can have let's say relief about your trading strategy and trading plan, and you can calculate the expectancy or expected payoff of your trading plan. So in that case, you can make sure that you are making money during time. So here how we can do it on TradingView. TradingView makes it easy to visualize risk to reward ratio with its built-in risk management tools. Select the long position or short term. You saw I use this horizontal lines to set my TP and stop loss. Okay. However, now I'm going to remove them, these horizontal lines, all of them like this. Okay, don't need them anymore. Uh, and now we can use some built-in features like this here on this right panel. On the left panel, you can find long position and short position. Now what they do, we can select each of them. Here we are going to, for example, long term market. Okay, so we can choose the long position from the drawing panel. So by placing it on your chart, you can visually see where your entry, stop loss, and target levels lie and what the ratio looks like. This helps in quickly assessing the feasibility of trades before they are executed. So all of the manual, let's say, works that we've done so far, we can make it very easy and simple and quick here by, for example, selecting our entry, and why we can't. Yeah, you see, I put it here. This is a long position. I bring it up. So I was mentioning that TradingView makes it easy to visualize risk to reward ratios with its built-in risk management tools. Here we selected the long position, for example, and also we can select the short position as we see the market is getting below this last market bottom here. And by the way, it doesn't matter. We are just going to take it as our example. So here you see, if I put it here, it automatically got my stop loss somehow, and then I'm able to calculate my reward to risk ratio very easily by just setting, but just adjusting this level here. For example, it can be one reward to risk ratio or less or more. So in that case, I will be able to count to see all the calculations regarding that. Good. So let's consider this as an example. A trade setup where you aim for a profit target at, let's say, for example, here 0.8687, or you can see the target here as well, 0.86734. Yeah, and have set a stop loss at this level here, and it's going to be somehow our entry point. Yep. So by placing it on your chart, you can visually see where your entry, stop loss, and target levels lie and what the ratio looks like. This helps it quickly assessing the feasibility of trades before they are executed. And here, for example, we have the reward to risk ratio, or let's say the risk to reward ratio here is 1 to 1.68. I can make it 2, or I can make it, let's say, 3. So by dragging this to the upside. So trades with a high risk to reward ratio allow for fewer successful trades to achieve profitability, and vice versa. Trades with lower reward to risk ratio can have a higher win rate, and it means they have more chance to achieve profitability, making them a key focus for strategic trading. And then we can assess whether a trade is worth taking based on its risk to reward ratio, because, for example, if let's say the market can't let's say break this important support level here and it gets back to this high, that would be a hammer candlestick shaped, and then we can anticipate the price get to this level, for example. So this is the first important resistance, and the one reward to risk ratio. So I can say for each dollar I risk, I can expect $1 as a reward. So in that case, that would be my first target somehow. Eventually, I can set my take profit at the higher levels, but it depends on the market that if the market can pass this important resistance levels all the way here, then I will be able to get to my target. By the way, it's not us as a trader who determine the profit, it's the market movement. So in that case, it's very important to be realistic with our, let's say, targets. So it was just an example. So we can do it vice versa in the other way. For example, we can say if the market breaks below this level, if you see, I can go through this, I can get to my orders, and I will be able to manage my positions. Right now, I don't have any open position here. And here the orders. There are two orders, one sell and one that actually buy a stop, and one stop loss level. And I can easily just delete both of them with canceling the buy stop. The stop loss order canceled automatically. So there is no any trade here. However, I can just think of a short position at this level, for example. So I can set my stop loss maybe this 18 pips away, while let's take a look at the ATR, which is at 24 right now, 24 almost. So the best way to put my stop loss is at this gap here, and then I will be able maybe to set take profit here based on some market levels. This is the breakout level, and then I will have these support levels all down here, so I can use it. Or the other way is if I anticipate a new downtrend, so I can use Fibonacci level here, and this is how you can use the Fibonacci from the lowest level of the trend to the highest level of the trend, and then I need to adjust it by adding some retracement levels, and I can just turn off the extension levels, and that's it. And that's how you can use Fibonacci on TradingView. And here you see I have my levels already here, so I can use them as a potential targets. And in that case, I see I'm going to face this market support here, and there is a chance that the market bounce back. So it's better to wait for this level. And if I see a clear break below this level, then I will go for the next level. And this is another technique for risk management, which is a partial take profit levels. So in that case, I'm just going to remove these lines here to make it not very, let's say, dirty and complicated. So here you see I can go, and now we have our next session started, and then this is a down scenario or this sell scenario. So I can have the first TP here. It's not the 1-to-1 risk reward ratio. However, it's more probable that the market gets to this level, and then I can expect some reaction to this level. So this is how we play this sell scenario here. However, you can also leverage multiple time frame for risk management. Markets can be unpredictable, as you see, and what looks like a solid trade in one time frame may not align with broader trends. Multiple time frame analysis allows traders to gain a fuller picture, align their let's say trades with broader trends, and thus reduce risk. So in TradingView, switching between time frame is simple and powerful. Let's start by identifying a larger trend using a higher time frame. For example, here we have a H4. We can switch to a daily time frame or even weekly, and then here you are able to see how market has been down all the day today. And it can give you a better understanding of the selling pressure in the market. So Start by identifying a larger trend using a higher time frame. And if you look at this USD CHF on a daily chart, and if you draw, let's say, this trend line here, you see how beautifully it has reacted to all of these levels. This is a tentative trend line till here, and then this is a confirmed trend line or valid downtrend line, and here is the market reaction to this solid resistance level. So then move to a smaller time frame, like what we did on a 4-hour time frame, for example, or a 1-hour time frame, to find an entry point that aligns with that trend. So then when we got that it's a downtrend, so we are going to look for sell positions, and here we are going to short the market below this let's say uh, last market bottom here. Okay, so we are going let's say this approach helps to ensure that trades are not only positioned in the direction of the broader trend, but also time to maximize the effectiveness of entries. Uh, this is a practical example you saw. So TradingView allows you to, let's say, synchronize drawings and indicators across multiple time frames, making it easier to maintain consistency in your analysis and ensure your stop loss levels and targets are aligned with the bigger picture. Synchronization helps prevent errors that arise from shifting between time frames, enabling traders to keep their technical analysis. And how we do that, you have this layer set up here, and then you can choose between these layers. For example, I went through the daily and H4 time frames, so I can use, for example, this setup. And here is the H4, and here I can change the time frame to daily, for example. And now you see how it works. Very nice and simple. And it's better to take it from here, and you see when you choose to sync in layout, is sync the symbols or interval or crosshair in the layout, so you have a very consistent let's say approach. You see my crosshair is moving on a daily time frame, and also have it on the 4H time frame, so it gives me a more or better understanding of the market anyway. So you can have all the tools, and you are able also to change the visibility of your let's say indicators on both time frame or not. For instance, when you choose only the you can just turn off any of those you don't like, and see is it's disappeared from here. However, you can have it on hourly charts, or only on minute chart or second chart ticks. That's it. That's just up to you to find the best way that you are so comfortable, and it's very straightforward for you to make your trading decisions. So this is how you can use TradingView to manage your risk in better way, and use let's say and make the most out of this feature. So I think that's all for today, and yeah, that's it. If you have any further question, please write it down to me. I would be happy to answer your questions. Yeah, a new joint participant asked that why is it important to always use a stop loss order? Okay, let's explain that using a stop loss order is crucial because it helps protect your trading capital by limiting potential losses. So it's a key part for maintaining risk control and ensures that no single trade can negatively impact your account beyond a manageable level. This is a common, let's say, our reasoning for using stop losses. However, we saw that if we want to calculate our the correct size of our position, it's vital to have a stop loss because we need a term as a pip at risk, and it's not possible to get there without setting a proper stop loss. So I hope that answers your question. Okay. Okay, thank you all for attending today's webinar on risk management using Errante's TradingView platform. Remember that risk management is not just about protecting your capital, it's about let's say creating a consistent approach to trading that gives you confidence and helps you stay in the game long term. So practice these techniques regularly and makes them an integral part of your trading routine. We look forward to seeing you in future sessions. Happy trading and stay disciplined. Thank you so much.